Welcome to the Invest Like a Billionaire podcast. I am your co-host, Ben Frazier, joined by fellow co-host,
Bob Frazier.
And today we're joined by François Braine-Bonnaire, and we're very excited to have him on. This is a continuation of our Passive Investor Spotlight series. So, François, welcome to the podcast.
Thank you so much, guys, for having me today. Very happy to be here with you.
Yes, we're glad to have you here. And if you can't tell, François has an amazing accent. He's actually from France.
That is true.
And is a dual citizen now of France and the U.S. And the reason we wanted to bring François on, so François is an investor of Aspen Funds and has been for about a year or so. He's got a really cool story, and we want to kind of highlight that. And in this series, what we like to do is interview successful passive investors and just hear about how they got to where they're at now and kind of the story and the journey, and then just kind of pull back the curtains a little bit of what are you doing, how are you thinking about your investments, what's kind of your strategy, are you looking more for yield, more for growth, and what spaces do you like? And so really excited to dive into this. These are kind of more just candid conversations and just really fun for our listeners to be able to hear from another fellow investor, like we're all investors here, and kind of what's worked well for you and where you're thinking about going forward. So really excited to dive in.
Thank you so much. I just want to disclose that even though we are at Invest Like a Billionaire, I'm not one of those, but I've been investing as successfully as I could.
And you've done very well so far. So excited to get into that. And just a real quick background on François. So he moved into the U.S. In 2010, I believe. And before that had co-founded an advertising agency, but then moved to the U.S. and very quickly saw the opportunity in the residential real estate space and started acquiring rental properties, so single-family rentals in his own portfolio, as well as being kind of an intermediary for some international investors who are looking to get good cash flowing properties in the U.S. And so really became kind of that go-to resource for a lot of your international clients in advising and consulting there, and has built up a pretty great rental portfolio.
And purchased over 700 homes yourself and with others, helping others. So it's going to be good to kind of dive into the SFR space, which a lot of people are thinking about.
Exactly.
Rentals, so.
Now, also currently, I think you still do kind of life coaching as well on the side from that as well. So, François, tell us a little bit about your story and how you kind of got to where you are now. And yeah, love to hear it.
Thank you so much. Yes, indeed. After being an entrepreneur in Paris, I was really excited about moving to the U.S. I knew the country. After my business school in France, I had the opportunity to be an intern in different setups in fun cities, which were LA and New York. And, in France, we heard about the subprime and the big mess of this wave of massive foreclosure.
The great financial crisis.
Indeed. And there was definitely an opportunity there. I was fortunate enough not myself to have lose any of my saving during this crisis, being invested in very secure assets at that time. And so, I moved to the U.S., studied the market. I have to say that I knew absolutely nothing about real estate investing back when I did that. So that was a bet. But it went very.
Why did you pick single family rentals at the time?
Because the prices were so cheap, and
were,
and I was a cash buyer thanks to my saving and the fact that indeed I had a company. I was able to sell my shares, and the opportunity was amazing, especially coming from Paris, where the price of real estate is just like terribly high, and there is no yield. And on top of that, the legal system in France is like the landlord is really the bad guy. And the tenant is super protected. So I was like, very easy to create a portfolio because the price per property was extremely cheap. We are speaking about 2011 and 12, and an incredible yield. So I started for myself, and it's true that I was able at that time in Florida or in Arizona or in Alabama and Georgia, which are the 4 states I'm the most invested in. I was able to buy 3-bedroom, 2-bath and put a new roof on them and be all in for $60,000.
Wow.
And rent them for more than $1,000 a month. So
you did the math and realized this is incredible opportunity. And
Incredible.
I remember actually in 2008 looking at Miami beachfront condos you could buy for $35,000 and thinking, oh my God, they're not making any more of these. And, now they're, you'd be a 10Xer. But at the time, so when you're landed in 2010, the market hadn't even bottomed yet. And the prices were still dropping. They didn't finish dropping until early 2013. And so you actually bought, which I love this. You bought even in a declining market, but you were a fundamental buyer. You bought based on economic fundamentals. Like, right, if the price continued to drop from 60,000 to 50,000, what do you care? Because you're earning $1,000 a month.
Exactly.
Right? So I love that. That's actually the right way to be looking at this. And in fact, in these declines, it's the time you can make outsized gains when you're not. Your fear is not dictating your actions, right? As investors, we got to just get rid of that. So,
and timing in the market, I mean, is like the dream of everybody. So it's like did I buy it at the perfect time?
Yeah.
I don't know. I'm starting to sell some of my rentals. We'll discuss that. Am I selling at the perfect time? I don't know. Future will tell. But what I do know is that the experience has been amazing, and indeed. My motivation was mostly income related, and getting 1,000 or more of rent per property was just amazing.
Yeah.
So had you been traveling to the U.S. Kind of before that and kind of familiar with it, or is it kind of just a big jump of, I'm going to take a risk and just move to the U.S. and see, knowing that you wanted to go do this? But to me, that takes a lot of guts, and especially in an opportunity that you just kind of saw, kind of take advantage of that.
Well, I mean, the waves of foreclosure were massive in well-known states like Florida, Nevada, Georgia. Yeah. I have to say that, for example, I was not interested in Nevada because it's based on the tourism industry, and I think it was too risky. Detroit is a city I've always neglected. And I'm happy with that because I think it lost too much of its population. But so I've been traveling in the States I was interested in. In Florida, I was looking all around. The city of Tampa got my attention more than Miami because Miami, as you said, Bob, was more like condo related, and I don't want to pay HOA because I think they are not good for your yield. And then I did other cities like Atlanta, Georgia, and I traveled Birmingham, Alabama, not very well known, incredible city. And I was able to pick and choose and find, after really studying all the players for like between 6 months and a year, or find people I wanted to rely on, because I did some of the stuff by myself, which is buying directly from the bank, managing the renovation. It's very time consuming. So sometimes when you can find turnkey providers who are going to do that for you against a small margin, well, when you make the math, it's definitely worth buying through them because they have a lot of value and you can invest your time in something else.
What drew you to kind of the southern and southeastern states in particular? Because now those are the states that everyone wants to be investing in, right? And you kind of heard the smile states, right? The kind of south and southeast and southwest as well. But 10 years ago, what were you thinking about these markets in particular that you saw that was attractive about them?
Well, Florida was a big magnet for foreclosure. So it was interesting. After, there was like a component of easiness to travel. So, I mean, Georgia is the unofficial capital of the South. Atlanta is. So I was interested. It was next door. Same for Alabama, where I was able to go. So yes, I mean, it was easier also for me to be working on states that are touching each other, neighbors on the map. I did work a little bit with Phoenix, Arizona, but it was like 6 hours or 5 hours flight away. And I have to say that because of that, I was not able to go as much as I could. So I was able to invest a little bit. If it was closer to me, I think I would have invested more. But yes, I mean, ultimately, there's only 24 hours in a day, and I've got just two hands and one brain, and I did the best I could with that.
Yeah. The South is becoming kind of an industrial powerhouse because of the affordable wages, and so a lot of car companies and others are moving down there. The real estate is inexpensive, the wages are inexpensive, and generally they're business-friendly climates, right? politically. So it's definitely a plus. But it's interesting because when you got into the single family rentals, that really was not a very popular thing, right? So generally, investors have favored multifamily because you get, hundreds of units, and they're very easy and cost effective to manage, whereas the single family rentals are very costly to manage, right? There's not a lot of efficiencies in managing an SFR. So let's talk about the SFR space. What do you absolutely love about the SFR space, and what do you not love about the SFR space?
And to be clear, SFR is single family rentals for those that are not familiar.
Which is a home that somebody rents. Yeah.
What I love about those is that you're able to diversify your portfolio, and at that time with a limited amount of cash per property. So I definitely prefer to have, 20 houses.
Spread over multiple cities, multiple geographies, so you're not...
Exactly.
I see.
Because for example, a small multifamily with like 10 units, it's more efficient in a way because you got only one roof,
right,
and maybe 2 or 3 HVAC versus 10. Right. So this is more efficient in a way. But if someone is building one next door to you, like half a mile away, that is looking better, everybody's going to move out, and then you put so much money in one single property, 10 doors, but actually a single property. So I didn't like that from the diversification standpoint. That's why I focus on the single family rentals for diversification. And but it's true that it's more work.
More management,
more maintenance, more work. That's for sure. I've always been helped by property manager.
So you hire a property manager, which makes sense. Is it one property manager for all of it, or do you have different property managers?
Very good question. I really believe that a good property manager is local and not nationwide. That it's really an expertise to know your tenants, to know your different neighborhoods. So I've got different property managers per city.
Yeah. Is it really passive? This is our, we're focused on passive investors, and I actually had a condo that I bought and I rented out, and it was a nightmare experience. It was, a lot of people I'm sure have loved, rentals, and made a lot of money on them. I lost money, and I hated the experience, and it was not passive, and I had a manager, but I spent money on roof and termites and, plumbing and electrical, and I think I had, two doors, right? And I had 3 evictions in like 7 years, and 2 freaking doors, So it was a horrible experience. I'm sure I did everything wrong, and I'm sure I'm a single family idiot, but really, is it really passive?
Yes, it can be. Is it as much passive as alternative real estate investment with Aspen Funds? No. But is it passive? Yes. But I would say, when I've been helping those 200 plus families around the world to invest into single family rentals in the U.S. in those past years, I told pretty much every single one of them, the cocktail recipe of a good single family rental investment is like 40% the property. Just don't make a mistake, and I'm going to help you not to make a mistake about the property selection.
To buy the right place, yeah.
Not too big, not too large. And then 60% of the recipe is the property management. It's like it's more important than the property itself.
So you need to manage the manager pretty much.
Yeah.
And just make sure they're doing their job.
Exactly. But as long as they are good, and I'm working with the best, because I made some mistake. But I've been working with the best for years, and you can rely on them, and ultimately the proper one, they are making a commission of your net income. Which is not the case all of them. So, for example, in Vegas, some property management company are going to take a flat fee, which means they have no motivation to keep your property.
No incentive
to. Yeah, it's ridiculous. It's not the case of the people I'm working with. So, we're on the same boat, and I'm sorry, Bob, that you had a bad experience. I got good stories, and I've got stories. Is it stressful sometimes, despite the efficiency of the property management? Yes, it is stressful. Do you find yourself in crazy situation? Yes. If you have a large portfolio and you're holding your rental for several years, you find yourself in crazy situation. But ultimately, the returns are are really amazing.
Part of it's probably like anything. There's a learning curve to it. If you just start with one,
I made every mistake in the book, I'm sure, but the frustration was on paper, I should have made a lot of money, but there was always deferred maintenance, or there was something that happened, that ate into my returns. And so even on a cash flow basis, I never made money. And then when I sold it, I didn't make money, even though the price was hard, but I put so much money into the place. Yeah. And so I did it wrong, but the paper was always great, but the experience never matched what I thought it should have earned. You know what I'm saying? And so I think you just got to be so good at really thinking through the costs and when you underwrite, right, to look at deferred maintenance issues and really plan on your maintenance and those kind of things. I mean, I don't know what are the keys to running a successful operation. So getting the manager 60%.
Yeah, property management is a key, good one. Not being cheap on the renovation. It's better to put maybe a new roof and a new HVAC and doing the depreciation when you start versus having bad surprise.
Pay for it up front rather than pay later as you go. Yeah.
Especially if you're financed, because in that case, you want your cash flow to be steady. Buying the right location. Insurance is a big topic. I mean, I spend a lot of money in insurance. In my opinion, you always get what you paid for, but specifically in insurance. I mean, in case of a big claim, you don't want to be cheap on the insurance. You want to have the replacement cost, not the actual cash value. You want to have enough liability, because a tenant might sue you for a crazy reason or try to sue you. So, I mean, you really want to work on that. And that's my expertise, and I've been doing it for many years. And after the people I've helped have benefited from my expertise, and I've done, of course, some mistakes, and I corrected them, and that's the way to do it.
So when you started doing these, you were buying kind of more foreclosed properties, more dilapidated properties, and then would fix them up.
Yep.
And then put renters in there. So that strategy is obviously a little bit more work on the front end.
The value add strategy. So you build in equity, basically.
Yep.
Yeah. And that's brilliant.
But then later on, it sounds like you kind of moved more towards just buying turnkey properties.
I did, because of the time. I'm really interested in the fact that I had the opportunity to do it myself, because I was able to understand the nuts and bolts of everything. But it's extremely time consuming. So ultimately, the money you're saving is not necessarily there versus the time you're spending on that. So turnkey properties has been my go-to after learning it by myself, and that's why I advise to my clients. Those people are abroad, so anyway, they're not going to. Most of them, they're not going to be from Paris. They're not going to say, "Well, have you assured that the new HVAC has been properly installed and properly caged for potential theft of the?" Yeah, of course, they are not able. So you need to rely on people.
Yeah. What's been your experience with the turnkey providers? Because you not being super involved in it, you hear kind of mixed things where it probably matters who you're buying from and the types of properties, because essentially they've kind of built in their profit, and they've already kind of captured that when they're selling it, and there's things to be aware of, and it's maybe not as passive as it could be sold as. But to your point, it sounds like you've had success with buying some that are kind of pre-renovated and already have a tenant in place and those kind of things. Has that been a generally positive experience buying from?
Yep. I mean, for the most part, yes, absolutely. And I've always forced myself, to buy properties for myself before offering that to the client I've been helping, to make sure that the process was going to be smooth, that the experience was good. So I'll always being the guinea pig for the clients I've helped, and it has been successful. And after a few years, you know what question to ask, and it went well.
Yeah.
So what are the things that are not to love about single family rentals? I mean, obviously you're still doing it, and it's a good business, but what is the reason not to do it? When would you advise someone not to get into single family rentals?
Well, I would say look at the market and where we are right now. I mean, for example, as I said,
is there a good deal?
Yeah, and all the markets are not the same. For example, I would think that buying currently a single family rental in Florida would be just a terrible idea.
Because the prices
Yeah, market is so high. There are some niche that are still very, very exciting, and Alabama is definitely one of them, because it has been a little bit under the radar of the big operator.
Right.
Like, for example, when Buffett said, I think it was in 2011, he said, "Well, if I could purchase myself,
I remember that
250 on MSNBC, if I could purchase myself 250,000 single-family rentals, I would do it tomorrow." And then Blackstone started.
Then everybody did it.
And Blackstone started their company about that, Invitation Homes. So it's you have to look for the good market, for the right people. Don't invest in the market just because you think Florida is going to still going up, if you are not ready for some headache, if you really want something totally passive with no decision making and no good year and bad years, if you want to things extremely steady, it might not be for you. I mean, ultimately, on the long term, like several years, is going to be really, really good. But if you want something super steady with nothing in your mind, well, go to Aspen Funds.
Yeah, there you go. So one of the interesting things, we've done some research on the single-family rental market in America, and particularly the public companies. So there is a handful of public companies. So I'm sure someone listening to this podcast is going to go, "Man, I love François. That's smart stuff. I'm going to do single-family rentals, but I don't want to do the work of it. I'm going to buy this company that's a public company that does single-family rentals." Well, we looked at this company, a couple of them actually, and it's insane, the book value. I don't know how much you're familiar with accounting, but so here's what's happened. These guys basically buy, let's just round the numbers. We'll say $100 million in real estate. So they'll buy a couple thousand homes, or whatever, and put in $100 million in real estate. They buy this real estate and they're renting it out. The market value of these companies is $300 million. So in other words, if instead of you owning a part of a $150,000 house, you're owning a part of a $450,000 house that's actually valued at $150,000, but you paid $450,000 for it as an investor. Do you understand? You paid $450,000. It's insane. The public markets are just absolutely brain dead right now and overvaluing the properties, and it's because it's public, it's easy to invest, it's liquid. Yeah. But what someone on the show recently said, REITs, real estate investment trusts, are not real estate. They're stocks. In fact, they are, and things like that prove it. It's more like investing in Elon Musk or whatever, or some technology than it is actually buying real estate. If you want to own real estate, buy real estate, or buy alternative investments in real estate. So that's more of a rant, But what are your thoughts on that, Ben?
Yeah, I mean, I think a lot of it is just the market as a whole, and there's so much demand for yield. Mm-hmm. And one thing that's so interesting to me is you said you've represented over 200 international families from 15 different countries, and you've purchased over 700 properties. And so, to me, I mean that says that there is really a unique opportunity in the U.S. For yield, right, where you can't find maybe in European countries and other places. And I think at a the public market level, we're seeing a lot of this appreciation wherever there's yield, you're seeing it being driven down. The cap rate compression, it drives up the price. And whether it's overvalued or not, it's still, there's demand, and people are willing to take more risk for less yield than they ever have
in a moment. And then the next day they're not, and the whole thing sells off by 60%, and this volatility. And that's what you have because of this crazy, it's all driven by emotion and not by math, right? And so you were math driven. You're a math investor. You invested based on mathematics, mm-hmm. right? Versus emotion, And the public markets are all the more reason why we need to be heavily invested in alternatives, and why billionaires are doing this and why everyone else should. But
yeah, absolutely.
When it comes to REITs, I'm with you. I definitely prefer the private REITs, which are much less
Yes.
liquid, but also much less volatile. So that's definitely what I do. When it comes to listed REITs, I'm much more cautious. Yeah.
Let's kind of talk about the international angle for a moment. So I actually spent some time in Europe. I've traveled quite a bit in Europe, and one of the things that's astonishing to me as an American to go over there and the real estate is tiny. Like they would put me in a room that was no bigger than a bed, and they think it was normal. I feel like I got to get outside to have some air to breathe, and it's super dense and super expensive. And, to me, one of the funny things about, it gives you perspective. Well, right now in America, everybody, because the prices have risen for single family homes, they're saying, oh, they can't go up anymore. And, affordability. But if you actually travel to Europe or to Asia, you see property values are far higher than they are in America. And the rents are higher too, but the density is way higher. So very much smaller square footage and much higher prices. And this is where America is going. And you have more people, you have to put them someplace, it's going to go smaller. But give a perspective of, you fell in love with American real estate for the numbers reasons, so talk about European real estate and the contrast.
Well, just to give you an idea, the size of France is smaller than the state of Texas. So that's interesting to know. Uh-huh. And we still have close to 70 million inhabitants. So indeed, when it comes to the density, it's pretty dense. So nobody in Paris, for example, live in a single family, or pretty much nobody, maybe 0.1%. But even in a single family house, everybody's in condo because we don't have much space. So
what might a condo sell for right now in France, and what might it rent for? Just pick a typical scenario.
Okay, so let's say it's in square meters. So let's say that
you got to translate for us.
I'm going to do that, guys. I'm used to it. I would say that a 1,500 square feet condo in Paris, which would because it's small, it would still fit like a 3-bedroom, 2-bath, would sell for like 2.3 million.
What?
Yeah.
And what does it rent for?
It would rent for like maybe 5,000.
Wow. So your price to rent ratio.
What are the yields?
It's terrible.
The yields
well,
are
that's why I got my clients, because the price ratio, the rent ratio is awful, and I would say most of my clients from Europe, they did real estate investment, and some were very successful based on appreciation, because one of the perks of France, of Europe, is that the interest rate. You can leverage big time, and you can borrow at 1 to 2%. So it's more than free money with the inflation. It's below free.
Yeah. What kind of leverage rates will they, or leverage ratios?
It's more than, it's approximately the same. You can put 20% down, or maybe 15% down. But so that's interesting.
But the rates are way lower, because in Europe it's very common right now to have negative interest rates, which again in America,
it's difficult to
people can't even get their heads around that. What does that mean?
Yeah.
Do you have any experience with negative interest rates?
I'm too Americanized. I cannot understand that.
You can't either. Can you have a story? Can you tell us how does it actually work in France? Do you know?
No, I don't. I wouldn't be able to describe that. But indeed, it's like the interest rates are super low. So, and my clients, most of them, they bought rental properties and they leverage, and then you got the system that is, first of all, the taxation is extremely heavy. So even if you're a French fiscal resident, it's better for you to invest in the U.S. than France.
You're kidding me?
No, it's really, really more favorable. On top of that, the legal system is against you. The tenant is the good guy. So if you have a tenant in France and he's not paying, in a good case, it's going to take you 18 months to get him out of the door. And of course, in the meantime, of course, you will not have cash, 18 months of rent, and it's going to trash your place. So I mean that's because there is so much system to protect the tenant, so that it's totally against the landlord. So a lot of my clients, they burnt their wings doing real estate investment in France. They say, okay, well, I'm done, and they liquidate their real estate, sometimes with appreciation. That was and then say, well, I'm going to go in a more friendly country for landlord, and that's called the U.S. Even though, of course, the U.S. from one state to another has very different regulation. It's better to be a landlord in Alabama or Florida than California or New York. Yeah. But
I think it's a really interesting point that you're making, because it really plays into a lot of the macroeconomic picture that we talk about a lot, and that we're seeing in real estate, especially in residential real estate, where some people look at the past 10 years and run up in value and get really uncomfortable and say, oh, well, we're going to see another crash. Prices are getting too frothy.
And all you got to do is go to Tokyo or go to Seoul, Korea, or go to Paris, France, and realize that, wait a minute, this could go a whole lot higher.
Yeah, and a lot of that will be driven by what the interest rate climate is going forward with the Fed, and do they raise interest rates if we hit higher inflation? But we can see both sides of it. We can actually see U.S. following the trend of European countries going negative, and if that's the case,
negative rates,
and if that's the case, I think that's only a boon to real estate prices.
If there's negative rates, you will see all investment classes skyrocketing. Yep. Because when money is cheap or free, or even getting paid to do it, to borrow, then you're going to see people do it. So and the other thing here, so there's this whole subculture in America that's kind of anti-America, and America is a terrible country, and got a terrible history and has terrible sins, and we've got plenty of sins, but in our past, but and a lot of people are talking about the dollar collapse, and gold going, and it's almost laughable to me that people believe this stuff. And you look at the money, for example, of all these 200 families that you've helped, they're selling euros, they're buying dollars to put it into American investments,
Absolutely.
Which are far superior. This is still the world's top investment destination for literally all the reasons that you've said. And the top industrial destination too. There's plenty of reason to invest in America, and America is not going to collapse tomorrow, in spite of a polarized political climate. So that's we still have an economic powerhouse of a country that is actually undervalued still in an international sense.
Yeah, I'd love to shift a little bit towards kind of some personal portfolio questions, but. From your standpoint, when you're looking at opportunities, obviously you have a pretty nice portfolio of these single-family rentals. You've sold some of them and have placed them in kind of more other alternative investments, Aspen Funds included. What are you looking for when you're allocating and across these different opportunities? Are you more kind of income oriented? Are you more growth oriented? Kind of a hybrid? What's kind of your main goal?
My main goal has been income. And so I've been very fortunate, because on top of the income, and I'm sorry, Bob, to disclose that to you, but I would say since for the last 10 years I've been in single family rentals.
No, that's great. I'm glad it worked for somebody.
My net income ratio before personal taxation, but after paying everything, was about 9% on cash.
That's fantastic.
On top of that, because I was lucky enough to indeed buy at the very low of the cycle, so 2011-12 for the most part, even though I kept on buying every year. The appreciation has been amazing. And I would say every year, even before the current surge that I could call the COVID-19 surge and appreciation.
Yeah.
So nowadays, this on top of the yield, I mean, my portfolio of single-family rentals has tripled in value. So which means it's awesome. But at the same time, when I'm looking at the cap rate of, not based on how much I pay for the property, but the cap rate of today, of course, the yield is much, much lower versus the value of the portfolio today. So that has been kind of what triggered my decision to start selling some of my single-family rentals. Because at some point you need to realize the capital gains that with or without 1031 like an exchange. But it is important to do so. My opinion is that because we are printing so much money, that the taxation in the US is poised to go up. I mean, it's pretty clear. It's going to happen. So I think I prefer at some point to pay capital gains now and sell the rentals and move steadily towards a totally passive and not half passive real estate alternative investment like with Aspen. And when it comes to the global allocation, Ben, I would say that I'm still very, very heavy on purpose on real estate, any kind of real estate, maybe 60 to 65, stock market 30, and different kind of assets like whole life, dividend paying life insurance or private equity, maybe 5 to 10%. I don't have anything in a hedge fund. I know that's one of the topics you covered with the podcast, but I don't. That's what I do.
What other real estate do you like besides SFR?
Aspen. No, but I like though. I like Aspen Funds for sure. I like private REITs versus the listed REITs. I want exposure to property that are too expensive for myself. So like big multifamily, not like the 10 doors, but like the big sky rise, or even REITs in industrial properties. Of course, like everybody, I'm currently away from office space, but this is what I enjoy.
So who do you kind of have in your inner circle? You've done an amazing job building kind of your net worth and have hit some amazing luck and fortuitous timing in the single family space, but also you saw the opportunity and you're very educated and you take cautious risks. And so who do you kind of have that's in your circle? Where do you get the information when you're making these decisions, and how do you network? And I know you work with some advisors, but what's kind of the decision process and kind of your inner circle of resources that you use in protecting and growing your wealth?
Definitely I've got different financial advisors, but I say I would use those guys mostly for the stock markets.
Okay.
I do read, I do research, I do have my network. I've got real estate mentors. I mean, let's keep in mind that I had back in 2010 zero experience with real estate, especially in the US. So I really wanted to surround myself with successful people, which I did in every single cities. I was invested in local super successful investors, not necessarily public figures, but people who have been super successful in the cities. I was. So I've built and strengthened my knowledge on that. I always consult with my CPA too.
Yeah.
I mean, it's a great resource, and I'm always putting into perspective the taxation when I'm making a decision, like to go from owning single family rentals to a passive real estate, which are non-qualified dividends. Those are the main people. Of course, as I say, insurance. I mean, I spend so much money on insurance on the professional and personal basis. I mean, that's important. Attorneys too. That's the people I like to consult with.
And listen to podcasts. I think we met you through a podcast, right? Originally.
Absolutely.
Now you're back on our podcast.
That's a good story. I love to listen to podcasts, and I did a couple of times the one with Monica Sawyer called Real Estate Investing for Women, and I've written one of the chapter of our latest book, which was about real estate investing in the US when you are actually a foreign resident. So that was interesting, and so I listened to the podcast, and last year I'm listening to the podcast, and then here you are, Bob, doing the podcast about a topic that I didn't know much about, which was mortgage fund. So I was super interested in this episode, and then I contacted Ben, and then I became your client, and I've become since then your growing client.
One of our favorite clients.
One of your growing clients. And definitely research, networking, and surround yourself with good people. Get good mentors. And
that's awesome. So, kind of the last few questions here, what we always like to ask are, what have been your most successful investment, your best investment, and then what have been your worst? So, if you feel comfortable sharing any of those, but that's always kind of fun just to hear the wins and the
Well,
challenges.
definitely single family rentals.
Yep.
And the fact that
you said the values have tripled.
Since triple in
That's
average.
incredible.
So I mean, some have doubled, and some have been multiplied by 5. Since purchase in 2011 or later, but triple. Keep in mind that you're not keeping multiplied by 3 in your pockets. You need to pay capital gains, tax depreciation.
Sure.
I mean, you need to pay stuff, and it costs a lot of money to sell too. The seller is paying the cost, not the buyer. So that has been very good. Sorry,
The worst.
The worst. Well, hopefully it won't stay the worst for an eternal, indefinite period of time. But I've invested quite a bit in real estate project A-class building in San Juan, Puerto Rico, so U.S. territory, and I've done that.
What type of A-class office?
No, it's a mixed use. It's very interesting. It's going to be it's an historical building. It's going to be short-term rentals like hotel or Airbnb, plus a food hall, plus a rooftop bar. Amazing location in the old city. And in San Juan, 97% of San Juan was declared opportunity zone. So that was interesting because it was actually
huge tax advantage.
Huge tax advantage. And then COVID hit. And so the property is still not open. It's so far 2 years late. The equity part of the investment has been invested in renovation. And then now the debt component is very difficult to secure because lenders are not very excited about lending to hospitality industry. So it has been difficult, but it's a good team. It's a good location. I think Puerto Rico, being a U.S. territory, is going to be super successful tourism-wise in the coming years. And so, I mean,
long term, it's probably fine.
Long term, it's fine. Short term, it's not good.
Awesome. Well, Francois, is awesome to have you on. Thank you so much for sharing kind of your story, and it's really fun to hear and just cool perspective. I love kind of having that really broad perspective of kind of
it's awesome.
Where you're from, just bringing a lot of enlightenment to our listeners who maybe just haven't invested or seen other places outside of the U.S. So appreciate that. Thanks so much, and really had fun having you on.
Thank you so much, both of you, for having me today, and congratulations again for what you do with your team with Aspen Funds.
Thank you.